It is 1720, and the clatter of coins in London's coffee houses is drowned by the roar of a single, impossible promise. A pamphlet, bright with the emblem of a seahorse, declares that the South Sea Company will turn Britain's debt into gold. Within days, merchants, clerks, and country farmers line up to buy shares, believing that the ocean itself will deliver riches beyond imagination. The air in the city feels electric, as if the very wind carries the scent of wealth. The South Sea Company did not spring from reckless speculation, it was born of a desperate government effort to manage a mountain of debt. By the early 1710s, the Crown owed millions of pounds to a diffuse network of creditors, many of whom were former soldiers, merchants, and small investors. In 1711, Parliament granted the company its original charter, authorizing it to assume a large portion of the national debt in exchange for shares and, crucially, a monopoly on trade with the Spanish South American colonies. The charter was renewed and expanded in 1719, a move that solidified the company's legal standing and gave it additional borrowing powers. The promise was simple on paper: swap government bonds for company stock, send a handful of ships to the Pacific, and use the anticipated flow of Peruvian silver to pay off the debt. First beat, the fever spreads. In the spring of 1720, a handful of influential financiers, among them a director whose name would later become synonymous with the scandal, began to sell small parcels of their own shares to the public at modest profit. Their gains were reported in the daily newspapers and whispered in taverns across the city. Ordinary people, many of them barely literate, heard stories of men who turned a few shillings into fortunes overnight. Sensing a windfall, the company's directors released new shares in ever larger batches, each issue priced a little higher than the last. Within weeks, the price of a single share, which a year earlier had been a modest few pounds, surged to well over £100. The rise was not driven by any cargo arriving from the New World. The company's fleet had barely left the Thames, but by pure speculation, by the belief that everyone else was already richer. Second beat, the crowd swells. By midsummer, the informal trading floor of the London Stock Exchange, still a loose collection of merchants in coffee houses, resembled a battlefield of shouts and frantic hand signals. A young clerk from a provincial town heard the news from a travelling merchant and rushed to the capital, selling his family's modest farm to buy shares. A widowed sempstress in the East End traded years of savings, accumulated from stitching for the aristocracy, for a handful of certificates. Even members of the landed gentry, wary of being left behind, borrowed against estates to purchase the glittering paper. The government, watching the flood of cash, granted the company further privileges, including the right to borrow additional portions of the national debt, reinforcing the illusion that the venture was effectively state-backed and therefore safe. Third beat, the bubble inflates. By August, the price of a share had reached a staggering level. Contemporary accounts speak of investors holding paper worth many times their annual income. The frenzy spilled beyond England. Investors in the Dutch Republic and the American colonies bought British-issued South Sea stock, convinced that the company's monopoly would unleash a tide of silver that would enrich the whole Atlantic world. The directors, sensing the moment, began to manipulate the market more overtly. They arranged for a small circle of insiders to sell large blocks of shares at a premium, then disappear with the proceeds. Meanwhile, the company published optimistic, sometimes exaggerated, accounts of potential trade routes, feeding the hope that a single voyage could return with enough silver to pay off the nation's debts. The hidden truth emerges. In early September, a group of skeptical investors, led by a seasoned merchant who had witnessed similar schemes on the continent, demanded a full accounting of the company's actual trade activities. When the company's books, kept in a modest office near the Thames, were examined, a stark reality emerged: only a handful of ships had left port, and none had yet returned with any cargo of silver or spices. The promised monopoly was more paper than practice, hampered by the Spanish Crown's control of South American ports and the ongoing war in Europe. Moreover, the company had been issuing new shares at an ever-increasing rate, effectively diluting the value of earlier holdings. The merchants who had sold their shares at a profit now found themselves holding paper that was rapidly losing any intrinsic worth. Fourth beat, the crash. News of the accounting leak spread like wildfire. Within days, panic erupted. Traders began to sell shares en masse, driving the price down from its lofty heights to a fraction of its value. The coffee houses that once rang with cheers now echoed with cries of bankrupt and my life savings. A young farmer who had sold his land found his share certificates worthless, his family's future evaporating before his eyes. The government, which had lent its credit to the scheme, was forced to intervene. Parliament summoned the company's directors for questioning, and the king's advisors scrambled to contain the fallout, fearing that the loss of public confidence could topple the entire financial system. The aftermath: a nation in debt and doubt. By the end of 1720, the South Sea Company's share price had collapsed to a few shillings. The directors were arrested, and a series of investigations revealed widespread corruption, bribery, and the manipulation of parliamentary votes. In the wake of the scandal, Parliament passed the Bubble Act of 1720, aimed at regulating joint stock companies, and later legislation provided limited compensation to the most devastated investors. Estimates suggest that the total loss to the public may have reached several £million, a sum that represented a significant portion of the nation's wealth at the time. The scandal shattered public trust in both the market and the crown, ushering in a period of financial conservatism that lingered for decades. Yet the story does not end with the legal proceedings. Historians still debate the deeper causes. Some argue that the bubble was simply a product of human greed, while others point to the structure of early modern finance, its lack of transparency, reliance on personal reputation, and the ease with which a handful of directors could secure parliamentary privileges. The episode also highlights the role of political ambition. The company's directors leveraged connections to the royal court to obtain privileges that were never intended for a private venture. The South Sea debacle became a cautionary tale that echoed through later crises, from the Mississippi bubble in France to the stock market crashes of the 20th century. As the dust settled, the streets of London retained the faint smell of burnt paper and the memory of a promise that turned to ash. Families that had built modest fortunes over generations found themselves starting anew, while the elite who escaped with a profit retreated into their estates, their names forever linked to a scandal that reshaped British finance. The lingering question whispered in the corridors of the old stock exchange is whether any system can ever truly prevent the next wave of speculation, or if the human desire for a shortcut to wealth will always find a new vessel. And so, more than 3 centuries later, the empty ledgers of the South Sea Company sit in archives, their faded ink a reminder that even the grandest promises can dissolve into nothing. The echo of that 1720 frenzy still resonates. If a single pamphlet could ignite a nation's savings, what modern whisper might ignite the next great collapse? The answer remains hidden, waiting for the next generation to decide whether to learn from the past or repeat it.